Hello everyone and welcome to today's webinar where we'll be taking a look at carbon reporting schemes and how to minimise the pain and maximise the benefits. My name is Stephen Kennett and I look after the Energy and Carbon Management Working Groups here at 2 Degrees. I'm delighted to welcome our two presenters today from Carbon Clear. We have Stuart Lemon, Head of Advisory, and Nick Bolland, Senior Consultant. Today's presentations will last for around 30 minutes, which will leave us with 10 to 15 minutes for questions at the end. Before we begin, I'd just like to remind everyone that you can submit questions throughout the webinar using the Q&A box on the bottom right-hand side of the screen. Just type in your question and press send, and then we'll wait till the end before answering as many as we can. As an aside, if you should have any technical issues during the presentations, please use the chat box on the right-hand side to send me a message, and I'll get back to you as soon as I can. So without any further delay, I'd like to hand over to Stuart, who's going to get us started with today's webinar. So over to you, Stuart.
Stephen, thank you very much for the introduction. Welcome everybody to our webinar today. Hopefully you can hear me. As Stephen said, if you can't hear me, I'm too quiet or too loud, please do use the chat box to let us know and we will try to correct that. My name is Stuart Lemon. I'm the Head of Advisory here at Carbon Clear. And hopefully, if the slides begin to work, you should be able to see my photo and the photo of my colleague Nick. There we go. Apologies for that. Just to put a bit of context as to who we are and what we look like. We're not in black and white. We are in full colour this morning. But there we go. What I'm going to talk to you today about is carbon reporting and how to maximise the gain from what is becoming an increasingly complex part of corporate life. We're going to look at, to begin with, the various carbon reporting schemes that are out there, both the mandatory schemes and the voluntary schemes, how they all fit together, what the overlaps are. Nick's going to take us through that in a second. And then I'm going to follow that up with a little bit of insight, hopefully, around what is good practice in terms of carbon reporting. I'm going to share with you some of the case studies and examples from clients that we've worked with over the last few years, just to highlight some of the activity that's going on out in the marketplace and where organisations are adding some value by getting their carbon reporting joined up and doing it right. In terms of sort of context and perhaps a slight caveat, I'm very clear and we're very clear that each company is different. So each of you listening into this will probably have a different set of schemes that you report to and different issues within your organisation. So there's no one size fits all, but hopefully what we're going to present will give you a good detailed understanding of the piece in terms of what you may be required to report on now in the future, and also a good understanding of a basic process to think your way through in terms of simplifying this, what can be quite a burden, and getting some value out of that. As Stephen said, we're aiming to speak for 25 to 30 minutes with a view that at the end of that there's time for questions and answers. Okay. That's it for the introduction. I will do a very brief introduction to Carbon Clear. There's obviously a lot more information about us through the 2 Degrees network and also on our website. We have been around for 8 years now, and as such we were very much one of the first organisations into the carbon management marketplace. And what we're going to speak about today is hopefully good practice drawn from experience of helping hundreds of organisations calculate and report their carbon footprints over that 8-year period. We are a global organisation. We're speaking to you today from our office in London on a very grey and dreary day here near King's Cross. There's about 20 of us based out of this office, and we've got 10 scattered around the world in other locations. We're quite a small team, quite multidisciplined, but we do have a lot of experience, as I say. And what we're going to look at today really just draws on that experience. The key to what we do and how we do it, which you'll see in the description on the right-hand side, which I'm not going to read for you, but the key words, the keys for us we're into long-term commercial value. Carbon management for us is not a one-off exercise. It is something that, if done well and embedded in the organisation, can deliver some really good commercial value for the organisation, and obviously as a consequence of that will help you to be part of the fight against climate change as well. We mostly help our clients through a process of measuring and reducing their emissions and communicating those achievements to their stakeholders internally and externally. And that's really what we're going to look at today in terms of the process that we can go through to help to minimise the pain of carbon reporting. So before we look at that, though, I'm going to hand over to Nick, and Nick is going to take you through the various reporting schemes as they exist and have a look at how they fit together, where the overlaps are, and draw out some insight from that. Over to you, Nick.
Good morning, everybody. Hope you can hear me well. Okay. Thank you very much, Stuart, for the introduction. As Stuart said, I'm going to go through the different reporting schemes, both the mandatory reporting schemes and the voluntary reporting schemes, and try to tease out some of the similarities and try to look at some of the differences between the schemes. Now, I've got about sort of 10 to 15 minutes to cover what is probably 10 to 15 different schemes, so I'm going to do quite a high-level helicopter view. If people have particular questions on individual schemes, please send them across, and we'll try and answer them either at the end of the session or offline. So I wanted to start with a sort of, as I said, a helicopter view. So this provides a bit of an overview of the different schemes we're going to look at. Just as one point, we're not going to focus so much on the Carbon Trust Standard. But what this graphic shows basically is, going from left to right, the increasing information requirements for the different schemes. So on the left-hand side, you've got the UETS. On the far right-hand side, we've got the Carbon Disclosure Project. So you can see that there's an increasing amount of information required, from Scope 1 to Scope 2 to Scope 3. And I'm going to go through this in a lot more detail in the following slides. So in terms of the presentation and what I'm going to talk about, I'm going to go through the mandatory schemes and a little bit about them and what you have to report. I'm going to go through the voluntary schemes, talk a little bit about what you have to report. Can't really talk about the different schemes without looking at the reporting standards, so I'm going to spend a few minutes talking about those. And then at the end, I'm going to try and tie it all together and try to identify some of the differences and similarities, both within the different types of schemes and across the schemes themselves. So, moving on to the first part, which is the mandatory carbon reporting piece. So we've got the 4 different schemes here. So starting off with climate change agreements, they were one of the first things to be introduced in 2001, helping the UK to meet its Kyoto Protocol agreements. It's basically a tax. It's driving energy efficiency in the large agricultural and energy use industries, such as cement and chemicals and foods. There's 2 different ways that companies can participate, either at a sector level or as an individual voluntary signature. It covers both Scope 1 and 2 emissions, and it's an annual reporting target. Moving on to the EU ETS, introduced a little bit later. It's a cap and trade scheme, and it was introduced to drive energy efficiency and CO2 reduction across Europe. Covers about 11,000 individual installations, and the limit relates to the heat capacity within the individual installation. There's a March submission date, and the basic premise is to calculate your carbon dioxide, verify the carbon, and purchase offset credits. The CRC was introduced in 2010. It's basically a tax with some additional complications in it, but in all purposes, it's a tax on the amount of emissions that you produce. It was designed to drive energy efficiency and falls part of the UK's Climate Change Act. It covers about 3,000 companies in the UK, and the main trigger or the main entry requirements is consuming over 6,000 megawatt hours of electricity from half-hourly meters. It also includes gas supplies as well. As we all know, the deadline is for a July submission, and the main premise is to calculate your carbon and purchase credits. Recently introduced this year, first time reporting starting in sort of October this year, is the mandatory greenhouse gas reporting requirements. It's designed for information disclosure and reporting only. There's about 2,000 listed organisations, mainly on the FTSE exchange. It covers scope 1 and 2 emissions, and there's no specific deadline. It's in line with companies' financial reporting. I think the main thing I want to draw out from these different schemes is moving from left to right. They are directed to large energy sectors, moving down through smaller organisations. But in essence, there's very little similarity between the schemes. They all mainly cover different industries. They're designed in different ways. They cover different scopes, and they use different emissions factors. So going back to our original purpose, looking at kind of similarities and differences, the individual mandatory reporting schemes are different across themselves. Moving on to the voluntary reporting piece, everyone's probably familiar with the CDP and the GRI. What I wanted to do is maybe draw out some of the similarities between those two types of reporting mechanisms, and the Dow Jones Sustainability Index and the FTSE 4Good. For those who are unfamiliar with the DJSI and the FTSE 4Good, they are very similar in nature. They're looking at sustainability reporting, so lots of similarities to the GRI. They cover both environmental and social aspects. In terms of the DJSI, is a 4th of June deadline with results in September. FTSE 4Good is a kind of moving entry requirement with questionnaires going out in April and June and October and December. But the basic premise for both of those and also the CDP and the GRI is that they are looking for companies to disclose information and understand the awareness of sustainability issues and carbon. They're looking for organisations to calculate the financial impact of carbon reduction plans and particular risks facing the business, and to implement strategies to manage those risks. They're also focused on measuring results. They are also interested in and have points allocated to them for external validation and verification. And they're focused on transparent communication of that information. So in premise, there's a number of similarities between between all the voluntary reporting schemes. They are looking at similar information requests, and there's probably quite a lot of the activities done for CDP and for GRI that can be moved over or used to help report against the DJSI and the FTSE 4Good, if that was something that organisations wanted to do. I've just got a couple of questions come up. Do we want to take questions at the end? Okay, we'll take questions at the end. Okay, moving on to the reporting standards. So I'm not going to dwell too much on the greenhouse gas protocol, because most people will be familiar with that. What I wanted to do is talk a little bit about 1464 and some of the confusion I sometimes come across in terms of what all the different parts of 1464 mean. So ISO 1464 is a carbon footprinting and reporting standard. The -1 relates to calculating organizational footprints. So it's designed for companies, organizations, businesses, etc. There is another standard which is -2, which is exactly the same premise but focused on projects. So if you were to implement a specific project for a period of time, you would use that standard to calculate the emissions and the reduction. And then 1464-3 is the validation and verification protocol. So it's what the auditing teams would use to audit a greenhouse gas footprint, carbon footprint, and the reductions thereof. The last thing I wanted to talk about is the new the DEFRA reporting requirements. So here in the UK, we have the Department of Food and Rural Affairs, which has produced some company guidance on environmental reporting, including carbon. Now, that guidance document was updated in July of this year to include the requirements of mandatory carbon reporting. So, in my experience, a number of organisations are approaching mandatory carbon reporting, having used for a number of years the Greenhouse Gas Protocol. But in actual fact, the requirements for reporting against mandatory carbon reporting here in the UK will require organisations to follow and adhere to the DEFRA reporting requirements. Now, there's some very subtle differences between the two, mainly relating to how you report supplier-specific emissions and gross and net reporting, and how you deal with renewable energy and things like that. But the main premise for everybody listening is that what's in the GHG may not be applicable for your mandatory carbon reporting. Okay, so what I'm trying to do in this overview here is trying to identify how and if all this fits together. I mean, there's quite a lot going on this slide, so I just want to draw some common themes here. If we look at the first 4 columns, they cover the mandatory carbon schemes, and as you can see, there's very little similarity between them all. They're all relatively different, covering different aspects, with and without governance and strategy, etc. In the top right-hand corner, you've got the voluntary reporting schemes, and there's a lot of similarities, as I said before, in terms of reporting against strategy, reporting against governance, reporting against risks and opportunities. And I think there's some value in transferring some of the things done in one scheme to things done in another. The other thing I wanted to make people aware of is if we look across the table, rows 5 and 6, Scope 1 and 2 appears in all these schemes. And getting Scope 1 and 2 right will help you report against not only the mandatory schemes but also the voluntary schemes. And the last thing, as I said in my previous slide, is about the different reporting standards. So the voluntary schemes mainly are looking at reporting to the GHG protocol, and the mandatory schemes are the two main ones, the CRC and the mandatory carbon reporting, are reporting against the DEFRA requirements. Okay, so I'm kind of coming to the end of my sort of 10 minutes or so, but I just wanted to draw out some key messages. So, in essence, as we probably knew at the start of the presentation, voluntary and mandatory carbon reporting schemes are different. There is, however, some commonality in the reporting requirements for the voluntary schemes, and potential missed opportunities to take some of the information from one scheme and use it in another. As I said previously, Scope 1 and 2 is important for all the schemes. It appears and covers in all the different schemes. And the GHG protocol may not be applicable for mandatory carbon reporting. And I guess I just wanted to leave one final observation from my perspective is what are all these? Why are all these schemes here? What are they all part of? And I think the key thing that sometimes gets lost in all the reporting piece is these schemes are here to help reduce carbon emissions both in the UK and Europe. And I think sometimes that's lost when we get tied up with different schemes and how to report against them and what the individual requirements are. And I think I'd leave the audience with one last point, is that in terms of carbon reduction, the UK has committed itself to reduce its carbon dioxide emissions by 34% by 2020 from 1990. So for those looking at setting targets, emissions reduction targets, that is the UK global target of a 34% reduction by 2020 from 1990, which I think is quite an important context to use when setting reduction targets. I take the questions that have come up on the screen. I'll take those at the end of the session. So I think I'll hand over to Stuart and we can cover the next session. Thank you for listening.
Great stuff. Thanks very much for that, Nick. I think so. That excellent summary of the schemes. I'd add a couple of points. Firstly, that's not an exhaustive list. There are a number of others in the voluntary sector, which are potentially industry or sector specific, which people choose or are encouraged to report to. So bear that in mind when you're assessing the sort of landscape out there. Secondly, this is for organisations participating. This is an opportunity, and that's really what I wanted to look at now, because I think that this can be seen as a burden. Particularly with reference to the setting of targets at a governmental level in the UK, it is likely that these schemes will develop in future. We suspect mandatory greenhouse gas reporting for FTSE companies may bring in reduction targets in future iterations. Climate Change Act will be reviewed in 2016, and it's likely that a number of these schemes, EU ETS, CRC, mandatory greenhouse gas reporting, will be aligned at that time, and it may be that reduction targets are rolled out to the wider reporting environment. So in terms of that background then, what I was going to look at really is good practice. How do we look at good practice for carbon reporting, and how do we derive some value from this process? The key really is about having a joined up approach. I think it's easy to get confused by the landscape of reporting. People typically have responsibilities and systems that have evolved over time. As Nick said, EU ETS started over 10 years ago. Mandatory carbon reporting is a brand new requirement. So it's quite likely that even if your organisation is relatively mature in its approach to carbon reporting, it's likely that there is scope for improvement in the processes and systems that you have. And hopefully the approach that we take is one that can help you to find out where the areas for opportunity are within your business. And as I said, we do see this as an opportunity. We see this as an opportunity to get it right and to add some value for the business. And at the same time, it can potentially add a profile and increasing importance of the individuals who are typically in sustainability, energy or facilities functions who end up getting to do the work of reporting. I think quite often it's given as a task and not always accepted willingly as a task, but I think by getting a joined up approach to it and a good strategy in place, you can do this well, respond well, and add some value for the business and yourself in the process. So if we look at our basic process and how we plan for a successful approach to reporting. Firstly, the key for us is to get a strategy in place. Now, as I say, organisations have evolved their approach to carbon reporting over a period of time. Some are coming to this new, but in both cases it's important to have a strategy in place. And that's really a sort of drains up review of all of the things Nick went through. So what mandatory schemes do we have to report to? Which voluntary schemes do we choose to report to? What Scope 1, Scope 2, 3 data do we need to look at? Who wants the reporting and the outputs from that? So it's a stakeholder assessment and a landscape assessment, a very sort of typical strategy approach. Second item then is to learn from that and to collect and calculate your information and your data. Key here is making sure that your systems are fit for purpose. What we see an awful lot of are systems that have evolved over time and been added to incrementally that are no longer fit for purpose. I'll explore that in a little bit more detail. Verification and assurance would be the third stage. So once you've got your data and you've calculated your footprint, do you want or need that data assured? In the past, it's been less of an issue, but with the increasing emphasis on external reporting, particularly with mandatory greenhouse gas reporting, verification and assurance of data is very, very important and increasingly high profile. And then step 4 is all about getting the value out of the work that you're doing. Getting to the next stage, taking those numbers as read and then building on that to add some value for the business. So if we look at the first stage, and as we say here, don't run before you can walk, set a strategy. Key to this really is to look at the stakeholders both internally and externally. Now, depending on the scheme and the output, you will have a different set of stakeholders. But what we find more and more, particularly driven by CRC tax levels and mandatory carbon reporting requirements, is that company secretaries, group chief executives, finance directors, and the board are increasingly aware of the requirements for carbon reporting. So getting those individuals on board, involving them in the stakeholder discussion of what they want now and what they are likely to want in the future is very, very important. Key also is looking at external stakeholders. Do your investors care about this stuff? Do your customers and your suppliers care about this stuff? The other area where we're seeing voluntary reporting, and I say voluntary in a slightly loose sense because it's typically semi-voluntary, is for the large corporates stimulating their supply chains to report carbon performance data. It's increasingly common and it's increasingly detailed, and being able to respond to that can be business critical for some organizations. So step one is to undertake that stakeholder assessment. And the key outputs from that really are to understand what the boundary of the organization is, what the data is that you need to collect, the standards with which you want to collect it, the timelines that you want to collect to and report to, and what's going to be good practice for you as an organization. Once you understand that at a sort of strategic level, on a sheet of paper that doesn't look like an Excel spreadsheet full of numbers, you can then begin to look at how to craft your system. And coming from that analysis, you quite often find some interesting insights into your business and your business's operation. The example that we describe at the bottom of the slide there is for a client of ours who we've worked with for 3 or 4 years now. They're a large financial institution. Not a name that people typically outside the financial sector know, but they turn over trillions of dollars processing clearances for trades around the stock market. And they were looking to understand their strategic position because they were increasingly having to report carbon data both internally and externally. And that was their requirement. So we took some quite serious thought to putting together staff surveys. We did competitor benchmarking work, and we determined their current market position in terms of carbon performance and reporting, and worked out what they wanted to achieve. And actually, whereas we expected them to want to be very clear that they were doing this work and externally communicating this work and reporting it outside the organization, actually what we found was that the critical issue for them was an internal one. What they really wanted to do was raise the profile of their sustainability action, their carbon management action within the business. And we found that the staff were driving them to report their carbon emissions. We found that the staff were driving them to set aggressive targets for reducing their carbon emissions, and we helped them to put in a strategy and a set of carbon reporting processes that flowed from that. And that's been embedded well in the organisation, and the perception now of their sustainability and carbon performance has transformed, and the staff were very, very engaged and bought into that process. So in terms of their strategic approach, it was very much an internal one. Lots of our other clients look at this from an external perspective, and we can perhaps pick up some of those with the next couple of slides. Getting the data collection right, collecting and calculating the information is absolutely critical. This is the sort of bedrock of all work in this sector, and it really will come down to the system. As I say, lots of systems have evolved, they have iteratively developed, so undertaking a strategic review of whether your system is fit for purpose is absolutely critical. Bearing in mind that mandatory greenhouse gas reporting, as Nick highlighted in his slide, goes beyond typically what lots of organisations have done before. It looks at global reach. It looks at all Scope 1 emissions. That can include things like refrigerants. And it also requires the organisation to compare itself year on year. So having good baseline information about the structure of the organisation, acquisitions and divestments is all very important information to capture as part of the data collection system. Just having the carbon or energy numbers on their own is probably not going to be enough. And that's really a key issue for systems. Are they fit for purpose now, but are they really up to scratch in terms of the future and what you want to do with that? Another key point for me, I think, is does your system take more time to administer and use than the value that it adds. I had a very interesting conversation with a client last week at the Sustainability Leaders Awards, who was saying to me that if he could, he would convince his organisation to drop out of the CDP and not report, because he spends a lot of his time collecting data and driving reporting for CDP when he'd much rather be analysing that data and reducing his carbon emissions. Now, we're helping that organisation to streamline the reporting process and helping him to do that, and hoping that they won't take the drastic move of taking themselves out of CDP. But that's some of the sentiment that exists out there in the marketplace. So for the case study that we've got there, and this is a very, very large global organisation that we're looking at, we helped them to undertake a needs analysis of what they needed. And the critical issue for them is that they have 4,500 sites across the globe from which they're trying to collect energy and carbon information. This is both Scope 1 and Scope 2, and so some Scope 3 information as well. So we helped them to identify and implement a fit-for-purpose system. We helped them to train their staff and to build that system in such a way that most of the effort in data entry is done remotely, and the way that the system is set up, it drives that data collection. So it takes the onus away from the sustainability team, and it puts the emphasis onto the people who actually own the data. And it's done in a way that is very clearly governed and very clearly traceable and auditable. Part of what they, as an individual institution, were doing originally was calculating their carbon footprint to the GHG protocol standard. And as part of the assessment, it became clear that actually what they needed to do was do it in line with ISO 14064, so that they could subsequently audit it to 14064 Part 3, which Nick mentioned in his discussion. And what they've ended up with is a global system which gets data on a daily basis, but allows them to report at any time of the year. So any time that they need to report to mandatory carbon reporting, their own company report, Bloomberg, DJSI, whatever it is, they can effectively press a button and get a real-time view on their carbon data. Which is a superb position for them to be in, and exactly what they needed for their business. And it's taken a lot of the pain out of it and allows their sustainability team to focus on using that data and adding some value. I talked briefly about verification insurance. This is very much a horses for courses discussion, probably one to be had with stakeholders and one to be had internally. Some organisations now absolutely require external verification of their carbon data because it's issued in their company reports. New mandatory greenhouse gas regulations require for compliant companies that data is published in the director's report, in the annual report, but it doesn't actually require that is externally verified. So there is, to some extent, still choice as to whether you do this or not. In terms of you having responsibility for collecting and reporting that data, external verification is very useful and valuable because it allows you to sleep at night. It basically checks that your processes and your systems and your data are correct and accurate, and what you're reporting is a true and fair representation of your business's performance. And the example that we have there is a large industrial manufacturer. They collect their data from around 100 sites in the UK and across Europe. We developed a software system for them which manages the input and calculation of that data, but which sits on their server, and they populate that as and when they need to, and then they call us in each year to independently assure that the carbon footprint data is valid, been entered correctly, calculations have worked, etc., etc. That's issued in their annual report, and as of this coming year, they will also issue that in their director's report because they will now fall under mandatory carbon reporting. The last slide in terms of process is just around planning for the future, identifying the risks and looking at where to add value. Setting a strategy, doing a footprint, reporting it and verifying it, is all part of the process. This is really the opportunity for you to use that information to add some value. We have taken a number of clients through risks and opportunities workshops, taking some of the base information from their strategy and from their footprinting exercise to present back to the board and say, this is where you are, and this is what your competitors are doing. Where do you want to go? What do you see as the risks and opportunities? And the two things that come out of this really in terms of sort of intangible and tangible benefits, tangibly, by doing good detailed risks and opportunities workshopping and collection and analysis, you will be able to increase your CDP score quite substantially, which for a lot of organisations is quite a useful outcome. But it also allows you to engage internally in the organisation and get senior members of the team to realise that climate change is not just a risk. What really comes out of this, typically, and the surprise for most people, is that there is an opportunity to be had here. Most organisations can, streamline themselves by reducing the bottom line, but also improve their stickiness with their clients, their retention of customers, the efficiency of their supply chains, the engagement of their staff, their profile with their investor base. So there's lots of opportunities to be had from this if this process is done well and this information is used properly. And that's really where I want to end my discussion. That's the key. This is an opportunity, and the best systems tick away in the background, provide accurate information as and when it's required in a way that the strategy says it's reported and is needed, but then the value comes from understanding what the risks and opportunities are, mitigating those risks and developing those opportunities. So as I say, get the stakeholders involved, make the system fit for purpose, verify it if it's required, and if there's any doubt as to the data, look at the business on a global basis, look at the risks and opportunities, and hopefully that will then lead into a very sustainable performing business managed around a carbon agenda. That's it from me in terms of presenting. We've now got time for questions and answers, some of which I can see on the screen and some of which have moved. Yeah. The first question.
Hi, Stuart. Hi, everyone. We've got a slight technical issue. Stuart's dropped off the line at the moment. I'm just waiting for him to dial back in, and when he does, we'll carry on with the question and answer session. We've had lots of questions coming in, but there's still plenty of time left. So if you've got any other questions you'd like to send in, then please do. And if you just bear with me, and we'll get Stuart back online.
Hi, I'm hoping everybody can hear us. We had a slight technical malfunction at this end.
Hi, Stuart. That's great. Yep, you're back online now, so we can hear you clearly. Yeah, we'll go straight into the question and answer session now. We've got plenty of questions come in, but there's still time if other people want to send in questions. So
okay, excellent.
Maybe a good one to begin with here, and I expect it's a question lots of people will be asking, but how can an organisation decide on which is the best scheme to choose, particularly in terms of the voluntary schemes available? And what sort of things should they be looking to consider when assessing these schemes?
I guess I'll pick that one up. I think in terms of my observations for the voluntary schemes, there's Initially, when organisations sometimes approach this, they're looking at the data, so collecting obviously the scope 1 and 2 emissions, which is obviously incredibly important. However, sometimes they fail to understand some of the risks and opportunities and the strategy and governance pieces that a lot of these voluntary reporting standards require. So in essence, sometimes at the start there's a focus on data, whereas a lot of these reporting schemes are asking for more qualitative information as well.
Fantastic. Thank you. So another question here. If a subsidiary is registered in the UK but not listed on an exchange, and the parent company is listed on a relevant stock exchange but not registered in the UK, does the company have to report under the mandatory greenhouse gas emissions reporting scheme?
So the simple answer to that is no. So the regulation requires the companies, compliant companies, to be UK incorporated, i.e. registered at Companies House, and listed on a main exchange. So if the organisation is registered in the UK but not listed as an entity in its own right somewhere else, then it doesn't fall under mandatory greenhouse gas reporting. So in that example, the UK entity is not separately listed, and therefore it is not bringing it in. So I'm trying to think of an example without naming any corporate names. There are a number of quite large American organisations who are operating in the UK, who have a UK arm that will be a .co.uk company and registered at Companies House, but they are a subsidiary of whatever the organisation is, Inc., which is floated in the UK, and as they are floated, in America, and as they are separate entities, that doesn't bring the UK organisation in. The flip side of that, if you have a UK registered company that is listed on the New York Stock Exchange and it's the same entity, then yes, that would bring them in. But there are very few of those.
Great, thank you, Stuart. A follow-on question about the mandatory carbon reporting. Someone's asking, do you think this scheme will be extended in the future? And if so, do you have any sort of idea of timescale on that?
I think I'll have a stab at this one. Yeah, I think it is quite likely. There was discussion during the consultation period that mandatory carbon reporting would be extended to all large organisations, and they're typically, depending on which definition you use, described as those with over £50 million turnover or over 250 employees. There is at the same time a European Union move to require all the large EU companies to mandatorily report their carbon. So whilst it's not a requirement at the moment, I think it's quite likely that it will become a requirement in the future. Timeline for that in the UK is probably in line with the proposed revision of the Climate Change Act, which I think is set for 2016. The EU, it's been floated for consultation earlier this year. EU doesn't tend to move terribly quickly, so it's likely that anything that would come into an EU level would be 2016 or beyond. So I think it's a possibility, and it's certainly being talked about, but we're probably a little bit far out in terms of timeline to be able to give a definitive answer at this point.
I would agree with that sentiment. Looking historically at the mandatory carbon reporting schemes, they've started with the large and heavy industries and moved into the less energy-intensive industries. So I would assume going forward that mandatory carbon reporting will extend out to the smaller SMEs. But what the time frame is, as Stuart says, is a little unknown.
Great, thank you, Nick. Another question here. In the intro, you mentioned the Carbon Trust Standard, but didn't go into much detail on it later on in the presentation. Do you have any sort of thoughts around the Carbon Trust Standard and kind of where it sits in the scheme of things?
Yeah, sure. The graphic that I showed at the very beginning was built in a similar sort of time frame as the CRC was being rolled out. So when the CRC first came out, there was additional value from having the Carbon Trust standard in place in terms of the performance table. So that was the reason why it was included in that graphic. However, that requirement, or not the requirement, that level of additional benefit is no longer part of the scheme. So that was the reason why we didn't focus so much on the carbon trust standard. And as Stuart said, there's so many different schemes out there, we had to be quite selective. We couldn't cover them all in the sort of 10 to 15 minutes.
Great, thanks, Nick. Another question here. What about carbon reporting for SMEs? Do you kind of have any tips or advice for those type of organisations?
Yeah, I mean, I think, the same process applies. The key to good reporting and the investment of time and resource that's inevitably needed to do it is to understand what you want to get out of it. So following that sort of four-step approach, talking internally and externally to the stakeholders, working out why people want to do this, what they want to get out of it, and then putting in place a system that will gather the right information at the right timescale is a worthwhile exercise. And for an SME, it's probably easier because typically people are all together in one or two buildings. My sort of overall message on this is that the better quality data you can get from the start, the easier your reporting process will be later on. So we always encourage people to try and go as far as they can, as early as they can. So rather than just sort of saying, well, let's just look at scope 1 this year, to be honest, whilst you're setting up a system and collecting that data, you might as well collect scope 2 and scope 3 and have a full view on your business, and it will give you the opportunity to analyse all of the areas where carbon's being emitted. And carbon does equal cost. If you're emitting carbon, there's cost associated with that, either through the supply chain or just through direct energy use. So make it fit for purpose and do it well from the start.
Great, thanks, Stuart. A follow-up question to that. Someone's asking, is Scope 3 moving up the agenda for businesses?
Yes. The majority of organisations that report their carbon emissions routinely have been doing Scopes 1 and 2 for some time, typically because they've been brought in to the process by a mandatory scheme. A lot of those are now looking at Scope 3, partly because that's where the next opportunity for savings and reductions comes. Once you've had the low-hanging fruit from Scopes 1 and 2, the next place to look is Scope 3. But also because the various indices that report the information, particularly CDP and now GRI, are placing increasing emphasis on the depth of analysis and disclosure in Scope 3. So a lot of our work this year around CDP particularly, and we're a CDP accredited consultancy partner, was around helping organisations to quantify and disclose their Scope 3 emissions to maintain their performance in the CDP scoring matrix and the leadership indices. Great
stuff. Thank you, Stuart. Another question. So, Stuart, you mentioned a lot about streamlining data collection. Someone's asking, as a rough percentage, do you know how many organisations that you deal with still use Excel, and do you see this changing?
The million-dollar question.
The million-dollar question. It's a great question. If you listen to a lot of the sort of more the kind of market-leading software providers speak, they will all tell you that their main competitor is Excel. You can get Excel to do some quite amazing things, but it typically only goes so far. So if you look at the better systems that are out on the marketplace in terms of achieving high quality long-term carbon reporting, they not only collect the data and do the sums, which Excel is very good at, but they also manage the process. So you can set them up to report your data in different ways. You can set them up to automatically stimulate data to be entered by people all over the world. You can get them to extrapolate to fill data gaps based on sensible methodologies and algorithms you've set up. So they add a lot of value, and in terms of that streamlining process, they take a lot of the pain and chasing away from whoever it is who has the responsibility, allowing that person to focus on the output and hopefully doing some good with it. So I think probably I can't answer that question. If I had to, I would say that at least 50% of organisations probably still use Excel. I think most of them, as they develop those systems, are fed up with it and looking to get investment to put something better in place. That would be my view. Nick, I don't know what you think.
In terms of percentage, I'd say the percentage using Excel is going to be higher in the SME and supply chain organisations. In terms of the large corporations that have been doing this for a number of years, the percentage is going to be very small. They will have moved on to some type of web-enabled or more sophisticated carbon reporting software tool.
Great, thank you, Nick. So I'm conscious of time, but I think we've got enough for a couple more questions. And one that's come in, according to Experian, there are 1.2 million companies in the UK that can conduct an audit. However, the Energy Institute says there are 50,000 companies that have energy usage greater than 6 million kilowatt hours. This is greater than the 3,000 company figure you gave. Have you got any thoughts around that or any clarification?
Yeah, so the number that we gave of 3,000 qualifying companies is for the CRC scheme, the Carbon Reduction Commitment Scheme. And the qualification criteria for that, it's not the gross energy use of the organisation, it is the energy use that goes through qualifying meters, and those are settled half-hourly meters. And when you do that analysis, there are about 3,000 organisations that come into that. What that means, though, is that if they meet the threshold of having greater than 6,000 megawatt hours going through those settled half-hourly meters, that then brings all of their meters into the CRC scheme, and they have to report on them all. So as an example, we have a client who has around 20 settled half-hourly meters with a annual usage of, from memory, around 30,000 megawatt hours, and their total estate is closer to 60 qualifying other meters, which has a greater than 60,000 megawatt hours, if that makes sense. So the discrepancy here is around the detail in the CRC scheme and what qualifies you in or out, basically.
Great, thank you. Another question that's come in is, do you have much experience with nitrogen trifluoride as the seventh greenhouse gas? No, is the absolutely honest answer. I have come across nitrogen trifluoride in a number of industrial processes, but in terms of the process that you would go through in terms of reporting that, it's very similar to anything else. As yet, it hasn't So the process effectively, identify the operations and the activities that you as a business are responsible for, those that are within your organisational boundary. If you have a process that involves the use of nitrogen trifluoride, then you will need to assess that process to see whether the gas that you are buying and using is being emitted to the atmosphere. And you can do that through a simple process review and some inventory review, and if necessary, potentially you can get involved in monitoring. But typically those sorts of assessments are done on a sort of process assessment and an inventory basis. Great, thanks, Stuart. Another question here. Someone's talking. This is in relation to verification of voluntary schemes, but they're saying from auditing experience, they found that emission factors are not always updated and therefore aren't reflecting the correct carbon dioxide equivalent measures. Would you agree, or do you have any thoughts around this?
That's something that I've seen on a few occasions, especially where an organisation may be in charge of their carbon reporting internally. So there'll be somebody within the business looking after this. It may not be their full-time job, and so therefore they may not have had access to or even know of the latest emissions factors. So yes, it does happen, especially, as I said, with the more junior reporting organisations.
Great, thanks, Nick. And one final question, which is quite a nice one to end on, but what do you think the future is for carbon reporting?
Well, it's not going away, put it that way. I think certainly for large organisations, those that are in any of the mandatory schemes, it will become increasingly necessary. We talk sometimes here about it becoming just part of business, a bit like kind of health and safety is these days, and was novel for a lot of organisations 10, 15 years ago. I think the key to carbon reporting is understanding that it's not going away and getting on top of it now, understanding what your business needs to do, and also understanding what the value is that you can get out of it. You're going to have to invest time and resource in doing this, so do it well and make sure that it drives some value in the business.
I think from my perspective, I agree with Stuart, it's not going to go away. I also think it's going to become more and more complex. It's starting to move towards looking like financial accounting in some respects, especially when you look at some of the requirements for the mandatory greenhouse gas reporting. So I agree it's not going to go away and it's going to get more complex. But I also think, and kind of hark back to my point in my last slide, is that reporting is one thing, reducing is another. And I think, a lot of people I speak to who have to do carbon reporting are increasingly overburdened with the requirements and are frustrated that they're spending all their time reporting and not driving reductions within their business. And I don't know how companies get over that problem, but it's something that I've come across in quite a number of occasions.
Yeah, I would go along with that. I think getting it right, simplifying it, and then concentrating on the value add is definitely the way forward. And using the increasing emphasis on carbon reporting as a lever within the organisation, raise the profile, get the investment, and prove some value in doing it.
Fantastic. So that's all we've got time for now, but I'd like to thank Stuart and Nick for their time today and for getting through so many questions, and also for everyone who joined us for this webinar. Just to remind you all, a recording of the webinar and the presentation slides will be archived on the 2 Degrees platform. So I hope you found today interesting and useful, and that you'll be able to join us in the future for further webinars. So thank you.
Thank you very much.
Thank you very much.